Hello traders, welcome back to Simply Forex. Hope you're all having a wonderful trading day. Trader Tom here, and as you can see, I'm joined by David today, who I will introduce very shortly. Let me just explain why he is on the channel. So every Monday, guys, as part of adding value to you as traders and giving you more information, we are going to do a fundamental macroeconomic viewpoint of the markets, and this is David's specialty. So we're going to do this every Monday, guys. Look back at last week's, what happened in the market, and then also take a look towards this week and what could potentially happen in the market. If you like what David has to say, then please check out his YouTube channel, and he also has a regular newsletter as part of that as well. David, hello, welcome. How are you?
Hello, mate. Thank you for having me on. I'm pretty excited to do this because I haven't done a regular thing in quite a while, apart from obviously the stuff that you and I do together at Axie.
Yeah. Okay, cool. Yeah, and glad you mentioned Axie. So, guys, if you are interested in any of the promotions we're running on our channel and David's channel, then if you open up an Axie account, you can, take advantage of those. So David, let's just get stuck in. Let's talk fundamental macroeconomic. And if we start with, last week, first of all, what sort of moved the markets? What were you looking at? Give us an overview.
Well, the Swiss National Bank cut, didn't they? And I think some of the key components around the Swiss franc, especially versus the dollar, has been that although the dollar's been extremely strong, the Swiss franc has been even stronger, even amidst, the size of their balance sheet expansion, the fact that they've kept interest rates really, really low. It seems to have just been an eternal safe haven bid. I think because of a lot of the issues stemming from Europe over the last couple of years. They removed the peg back in 2015, which allowed it to free flow. But I think post-COVID, Europe has become very, very fractured. And so the Swiss franc's seen a lot of benefit, I guess, in the increase in price from that. The interesting thing, though, there is probably between the franc and the yen, because naturally they have very, very similar monetary policy stances, with the Bank of Japan probably being a little bit easier at the moment still. But I do see this SNB returning back to that ultra easy monetary policy. It's in their benefit. They run a really, really strange policy whereby they buy US equities and they basically make a load of money from buying US equities and then selling them. This change, however, could be a bit of a pivot. So we're already seeing rate cuts come into the market at the back end of the year in the US. So it could be that the Swiss National Bank is sort of front running this, I don't want to say recessionary behavior, but slight slowdown in behavior. So they decided to cut last week.
Yeah, sure. Yeah. And Swiss franc was crazy strong. Yeah, like I say, probably that, that safe haven. But, and we've had this conversation on my channel before. The yen, the yen is a flight to safety, as we know, but it's almost broken that correlation. And, with the indices at all-time highs, do you expect a correction there? And will that impact this yen weakness? Because yen, I've struggled to get in on yen. I'm like, it can't keep going. It's so overextended. But that yen weakness just keeps going.
Well, I think it's interesting that you say you struggled to get in on yen, because I feel like that is exactly what the Bank of Japan has wanted. Lots of people reckon that they're targeting a price when it comes to intervention. What they're actually targeting is to get hedge funds and speculators who are selling the yen really, really heavily, shaking out the market. Because if they intervene and then the dollar yen moves down, say 300 ticks, where do you put your stop? Especially if they're doing it randomly. It keeps happening very, very randomly in terms of when they actually do it. There's no specific price level at where they do it. So what they're trying to actually do is to reduce the position size against the yen by shaking people out and making people scared of being too big in the market. I still think it grinds higher, though. If we
Right.
look at how the US is positioned in terms of their monetary policy versus Japan,
Mm,
still very, very hawkish. There's big hawkish divergence there.
mm,
Um, Again, the US is set to cut later on this year, but if the US is set to cut, then what does that mean for Japan? Japan probably are going to be set to going back to, their pre-COVID era monetary policy. So
mm,
it's a really, really interesting dynamic there.
mm,
But the big issue is obviously permanent negative interest rates. Like, what
mm,
effect is that going to have on the Japanese economy, European economy, I guess Swiss economy as well? Is this the new normal?
mm.
Maybe. We're not sure yet, but we'll
Yeah.
see.
Okay. And talking about interest rates, obviously Swiss franc, the Bank of Switzerland, cut their interest rate. Bank of England kept theirs the same. What's going to dictate whether these central banks increase rates or keep rates the same? What do you think the catalyst for doing that is?
Well, the Bank of England are currently back at their target range, right? They're at, I think it was what, 2% on the CPI number core. The Bank of England's policy rate is 2% plus or minus 3%. That is their target. And I think the big issue with the Bank of England specifically is that a lot of the inflation faced came from the energy price cap. Now, a lot of people have considered the energy price cap to be something that is meant to be beneficial for consumers. What it's actually done is it's not allowed the market force at the time to price energy lower. It's kept energy artificially inflated. So you see over, the COVID period post the Ukrainian invasion, when gas supply was cut off to Europe from Russia, you see since then that UK inflation, headline inflation, remained much, much higher than Europe. And it's because all of these other countries didn't have this energy price cap that was
Mm,
put on them by the regulator, which is really ironic considering it's meant to help consumers.
yeah.
In actual fact, it's done the opposite. It's
Mm,
let energy firms keep the prices higher,
mm,
and the market price should have been a lot lower. So the Bank of England have effectively kept interest rates higher on an artificial government policy
mm,
rather than the, I guess, inflation targeting of the market.
mm,
This is where I think they've undone themselves. And I feel like inflation is going to tick down very, very quickly, especially if we do see, unemployment tick up a little bit more.
mm.
If we do see growth slow down, which we've had little murmurs of at the front part of this year. So I really think that's a big consideration. But growth absolutely will be the number one factor going forward as to what determines
Mm.
whether the central banks are cutting and raising or keeping the same.
Yeah, okay. And technically we had a recession in the UK. We had 2 months of negative GDP. Um, what are the central banks doing to turn that growth round?
Well, I think this is what it is now. It's coming down to what are the expectations of the market on interest
Mm,
rates in the US. If you look at secured overnight financing rate futures, shows that the cut is coming in December. Fed funds futures shows the same. It's basically the same measure, if you like.
yeah.
And so we're seeing 25 basis points definitely priced in for December this
Mm,
time. That doesn't mean it can't change. And I think the pricing is about 53% chance of a cut for
mm,
December. So this is where they're looking at things. But the problem is that interest rate cuts are very reflexive because they're done when they think that the economy is going to tank.
mm,
And the issue is that they forget that really they need to guide the market into the recession, if you like, or guide the market into recessionary conditions. But by cutting, it's almost saying to the market, we're panicking now. There's going to be a
mm,
recession, which then causes the market to absolutely crap its pants,
yeah,
and everyone then sees it as a self-fulfilling prophecy, if you like. So
yeah.
this is where I think Jerome Powell's actually been quite good as a Fed governor. He's
Mm,
guided well, but I do see the data slowly starting to turn. I mean, even if you
mm,
look at equities at the moment,
mm,
we're seeing those, AI chip stocks
mm,
slightly turning over the last week or two.
yeah.
Um, and we're seeing, crypto as well, which tends to be a very quick first mover because at the end of the day, it's a very speculative asset, right?
Mm,
We're seeing that down. Bitcoin's trading at $62,000 at the moment. So
mm,
we are seeing some pivot. And I think that's sort of respecting the fact that the market is a tiny bit concerned that rates are being cut because they're asking, why are they being cut? What are you foreseeing as the central bank, which is meant to know everything?
Yeah, and you touched on it there, you know, the Nasdaq, like you say, with these AI stocks, you know, it touched 20,000, which for me is a huge psychological level for the Nasdaq. And we saw a big daily correction candle, weekly correction candle. Do you see some downside to the indices here, or is it a case of just keep buying the dip once you get that retrace?
I think it depends on your time frame, of course. I mean, I do most of my my S&P 500 ETF buying in a SIP, and I'm 31, so I've got what, 30 odd years left. So even if it falls now, you know, it's not going to bother me if I'm still buying. If you're in leveraged futures, you're probably on a much shorter time frame. If you're in CFDs, obviously you're in a much shorter time frame. So I think it's important to be aware when people are saying buy the dip, your first question should be, what time frame are you looking at? Because especially on social media these days, people can throw out these different lines like, oh yeah, you know, I'm buying the dip, but it's like, okay, in what product, with how much size,
a bit of
and
context, please.
Some context, because otherwise you can lead people astray into thinking, right, it's going to go straight back up if I buy now, and it's like, no, you're just getting in at a decent cost, basically. So I think that's important. I will always buy into red candles though, on the S&P 500, just to be clear. Not in futures necessarily, so I'm talking really just about the longer term stuff, purely because I'm looking at the cost base as shifting up maybe, you know, 200-300 points a year. That's the way that I'm looking at it. So it's not really to say, I think it's going up right now. It's the overall position to be averaged in over time. I do think though, from what we know of easier monetary policy, if they start signaling easier monetary policy within 3 to 6 months, the market does tend to start rising again, purely because that risk-free rate is lower. The hurdle for buying equities and making it more profitable is a lot lower. So it makes sense from an opportunity cost perspective not to be in cash and to park it in equities.
Yeah, sure. Okay, so there's a look back at sort of last week and what's happening, you know, macroeconomically, fundamentally. And guys, if you're enjoying David's analysis, then please go check out his channel. The link is below the vid. He has regular analysis and he's got a regular newsletter. So guys, please join David's channel. And also, guys, don't forget to subscribe and like our channel. And also, guys, don't forget to join our trading community. We've got the free Discord channel and we've got some great promotions running as well. So check it all out. Right, David. So so that was, you know, the view. Now, I guess if you can sort of share your charts and tell us how this landscape is looking and how it's, you know, potentially giving you trade opportunities. What are you looking at? Specific currency pairs? Are you looking at the indices, even, you know, crypto? What opportunities are you seeing with this macroeconomic view you just gave us?
Sure. So I think in terms of FX, which I think we were explaining before the call, the way that I see FX these days isn't really on a swing or day trading perspective or anything like that. It's very much when I see more special situations occurring. So when I see pivots maybe in geopolitical risk, or if I see pivots in monetary policy or things like that, or some sort of idiosyncratic aspect of the market coming in, like with Swiss yen, it's very much a bond trade if you're trading it down to the short side. But I think the big one is the euro dollar, because my view is that the euro is consistently going to have to get weaker to support a lot of the European economy, because the European economy is very fragmented. You've got singular monetary policy across the bloc, whereby say, you know, a couple of countries might be doing really well, but then some other countries might be doing poorly. And the biggest thing right now is that Germany is doing quite poorly, but Germany is the key country for the bloc. And so if we just take that single perspective, I don't like bringing loads of different aspects into the market, just, you know, into my view, sorry. I just want to pick maybe one or two really key aspects and hammer those home in a nice priority. So Germany doing badly. They are going to need stimulating. They're a massive export country. What is the logical conclusion there? Well, a weaker euro should invoke stronger buy-in from abroad. It makes it cheaper for foreign companies, foreign consumers to buy German goods. If we take who the largest buyer of goods globally is, it's the US. So what is our logical conclusion? We look at euro versus the dollar because we expect US consumers who still have very strong growth to still want to buy German goods. The German government and the ECB would likely want the euro weaker to be able to facilitate this, to make the bloc look better. And so we're looking at this 15-year trend line and saying, okay, I expect the euro to get weaker versus the dollar. That is the trade in effect.
Okay.
And so from that, you can then, look at the levels that you might want to, take profit at, or you might want to scale in at, and you can say, this is how my trade plan is going to go. And so from my perspective, you probably want to look maybe there where the price rallied again, as somewhere maybe to take a tiny bit of profit off the table.
You've got
You're
a big
obviously gonna
psychological level there as well, where it gets to parity.
yeah, exactly. You've got just there that low and this one as well. So if we, depending on the volume and depending on the velocity of the move going into here, you might want to add some on there. And then, of course, you've got these lows, and you probably see retraces back up. Remember, FX volatility is still very flat. Ideally, we want some geopolitical events to be happening here. We want maybe the French election to speed things up. If we get a shock victory for Marine Le Pen, if we see the AfD in Germany, for example, come into power, this will all be net negatives for the euro. People aren't going to want to buy it. And especially around these levels, you'd want to see big shocks and big expectations beats that are negative for the euro coming into things. This is really where the macro side of things works. It's really to tick up volatility. That's what you want to see. And if I show you how bad euro volatility has been, you'll see why I want this. It's just been on a downward trend. If we just apply a quick linear regression, I can't remember where it is now. Not that one.
Too many tools on trading view.
Oh, there's too many. Too many. There we go. Sorry, it was right in front of me. So if we apply this from the start of 2009, and then we go to even here, you can see that the trend, so the middle one, that's the R squared. The trend has just been on. So FX volatility has been dampened by, low interest rates, quantitative easing, things like that. The interest rate differentials has just basically become really, really narrow. So that's why you get crap volatility in FX, and which is why you tend to see, 30 might even be quite big, 20 to 30 point ranges sometimes. It can be absolutely mind-numbing in FX.
Yes.
And so this is why we want that geopolitical risk to spark stuff up. And you even see here that if we look over the last couple of weeks since the French election, since the European elections, you can see that the volatility has ticked up a little bit. What we ideally want to see now, and it's been, we hit the highest since, the start of 2023, just last week. And so we want to see stuff like this because this is opportunity. It's the volatility that gives you opportunity. Volatility is a great thing. People hate volatility in trading. I think it's the number one thing that we need to look for. And so this is really why I focus on, okay, let's see some of that risk come back into the market.
And are you looking for that volatility in terms of it gives you some follow through with your move?
Exactly.
It makes the move last and happen.
Exactly. It lets you do stuff. And also, we got to consider that swap rates as well. If you're holding positions overnight, you lose. You tend to be losing and bleeding some money, right? Outside of some pairs, but brokers like to take the P. And I think it just basically lets you get the moves done quicker. It lets you get to your destination faster. When you've got volatility, it's like driving, a Tesla Plaid. When you've not got volatility, it's like driving, I don't know, what's a rubbish
A
car? Say
larder.
Ibiza. Yeah, larder then. Or 1 litre. Do you know what I mean? Like
Yeah.
it's just not great. You just don't get there fast enough. Everyone's frustrated.
Yeah.
And also, the good thing about volatility is that if you understand what the backdrop is that is causing the volatility, you're trading against people, especially in FX, who don't get that. And so it just basically provides you a nice unbalanced market. It provides you a market where there's lots of uninformed people that you can just, buy or sell into their flow.
Yeah.
So it works really, really nicely.
Yeah. Okay. All right. Well, thank you very much, David, for not only giving us the the macroeconomic view and an idea about the fundamentals, but actually giving us a real practical trade idea with Euro US dollar. And obviously that's a swing trade, David, that you're looking at there. How long will you typically hold a trade?
I think that could go on for, so not in one go. I would trade around a position.
Right.
Excuse me. So it might be sometimes that I'm completely out of it, but I would still
I
have the
see.
core thesis, if that makes
Yeah.
sense.
Yeah.
Like if I see volatility going down, there's no point being in there because I'm just going to go sideways and annoy myself. So
Yeah.
I cut it. When I see things picking up again, I get back into it, but always in the mind of, okay, this might be a 12-month long position.
Yeah.
But I won't always be in the market, if that makes sense. So,
Yeah.
elections and things like that, I think there's definitely event risk in the shorter run. So I'd say for this, 3 to 6 months, to be
Okay.
honest, with that thesis in mind.
Yeah.
I think the general longer term thesis of Euro, though, is definitely multi-year legged. Like there's a long, long way to go with the Euro.
Yeah.
And unless the US somehow blows up overnight, I don't see the direction for it being anywhere other than up. I see a lot of people, you just saw that chart there, talk about, yeah, there's a massive long-term trend line. If we tick above, then we're going to go, all the way back up to one spot 6. And it's like, well, nothing in the backdrop or the strength of the European economy suggests that we should go up there.
No.
So for me, it's just taking the balance of probabilities and saying the downside is more open.
Sure. And that's interesting. So if you had a technical break of that channel, that trend line, it still wouldn't be enough for you for it to outweigh the fundamental view you have of the euro. Your bias is still euro weakness, US dollar strength, regardless of that big structural trend break.
Yeah, it would have to be. It would certainly have to be, because as I've mentioned before, even if you look at the Swiss franc, that has been benefiting more than the euro over the last 15, let's say nearly 9-10 years, since 2015, since the break of the peg, since the D-peg. So the place to go in Europe for currency strength is the Swiss franc and not the euro. The euro is just way too fragmented, and the structure of the monetary policy and how it works across the bloc just causes that, basically.
Yeah. All right. Well, brilliant, David. Thank you very much for, sharing your insights with us today. As I said, guys, if you want to hear more of David's analysis, then please go check out his channel. His link's below the vid. Also has a regular newsletter that's just full of great analysis and great data, guys. So check that out. As I said, guys, this is going to be a weekly thing. So every Monday, David is kindly going to sort of take us through the macroeconomic fundamental view of the market and perhaps give us some, tangible trade ideas, or at least some currencies that he's looking at. He knows what he's talking about, guys. He's been doing this for 12 years now. He's worked for, many financial firms, and now manages his own money and client money as well. So, guys, thank you very much, David. Really enjoyed that. Super interesting. And we'll see you again next Monday.
Cheers, Tom. Thanks for listening, guys.
Cheers.